Assalamualaikum warahmatullahi ta'ala wabarakatuh, and hello to all of you. In this video, we are going to learn about chapter 4, risk and risk profiling in retirement planning. And in this video, we're going to look at the general definition of risk. We're going to look at the concept on different types of investment risk, how many types of investment risk that we have, as well as the subjective risk and how it affects investment portfolio in retirement planning. And the last one, we are going to look at the risk profiling for gauging the degree of risk acceptable to the client. Now we look at the simple definition of risk. We may define risk as the fluctuations or variations in investment return from the expectation with regards to an exposure. We are now looking at the fluctuations, if there is any fluctuations or variations. Variation possibly means that there is a variance in investment return, which means our predicted investment returns might have a fluctuation up and down, or might be vary between what we expect and what we get. From expectation, in the sense that the expectation is, like the return that we expect, and the return that we actually get might have some variation or fluctuation. And this variation might possibly happen due to an exposure of risk. Okay? And risk basically help to be present in all types of investment, but certain investment that we call it as risk-free asset are not affected by the fluctuation or variation due to this exposure. Okay, now we are going to look at the types of investment risk. So there are several types of investment risk, which includes the business risk, the financial or financing risk, the interest rate risk, the inflation risk, foreign exchange risk, as well as political risk. In respect to business risk is pretty simple. It is referring to the risk associated with the company's failure to generate revenue to cover expenses. Okay, means that this company failed to generate revenue, because revenue is important for them to cover at least these operating expenses, which includes the salary of the worker or the staff. These are among of the operating expenses that the firm must cover. Okay, therefore, because the basic of understanding or calculating the profit is where revenue minus with expenses. So when revenue is too low, and it means that it's not able to cater for the expenses, then the company are not going to get profit, but at the end of the day they will just get loss if the revenue is lower than the expenses. But if the revenue is higher than the expenses, then the company will get the profit. When we talk about the business risk, we can see that certain company that provides essential business, for example, the companies that provide electricity and water, basically this company is having low business risk. Okay, low business risk. Because why? Regardless of whatever happened to the economy, people are still using the electricity, people are still using water. Okay, so this is a part of the essential business that actually face a low type of business risk. All right. In the situation of COVID, for example, we can see that although at this point of time, we can see that the rate of unemployment has been increased, but still people need to eat. So the business such as related to food or the electricity or the water still can survive. Nevertheless, for certain business, for example, like the business that provide services, for example. Let's say the company is operating in IT sector, for example, during bad economy, for example, is having higher chance of business risk or more exposed to business risk rather than company that operate in the essential business. Okay, because once the economy is bad, once the economy is not that good, people will use the money for the basic or necessity only, for example, to buy food, and they are not thinking about buying high technology gadget, for example. So that's why the business risk in the industry or sector related to the IT or information technology will basically affected a lot during bad situation. Okay, we can understand actually in the business there are two types of cost. The first one is the fixed cost, the second one is variable cost. Fixed cost and variable cost. What actually make different between fixed cost and variable cost is where fixed cost is always maintained. It is fixed. The cost is fixed regardless the production that has been made by the company. So let's say the fixed cost is the cost of the factory. Okay, this is the leasing factory, means that we rent the factory, for example. So let's say for company A, the cost is about 1 million per month. Okay, which means regardless whether the company, let's say this is a company producing computers, for example. So let's say in month of January, let's say they produce 1.5 million unit of computer, or in February they just produce 50 unit of computer, still they have to pay 1 million for the leasing of the factory or the rental charge of the factory. Regardless of the quantity that has been produced by the company, the amount that they need to pay is still very, very high, or it is maintained. Unlike the variable cost where it actually varies, depends on the quantity of the output that has been produced. Okay, because if, for example, they produce 1.5 million units of computers, then the variable cost obviously will be very high. But if they just produce 50 units of computers, then the variable cost will be very, very low. Therefore, this cost actually will affect how the calculation of profits of the company. If the variable cost is high and the production is low, it is very likely that the company at the end of the day will have very, very low profit. But if, for example, the fixed cost is not that high, okay, in the case that fixed cost is not very high, regardless whether they produce high production or low production, it will not going to affect the profit very, very much. Therefore, this is also something that the company have to strategize. The company have to think when they want to make sure that they can avoid loss at all costs from their business. Alright, so at this point of time, you already learned about the business risk, where it affects a lot for the companies who are operating in non-essential business, while for essential business, business risk seems to be quite low. Therefore, as a financial planner, what will be your suggestion to the client is basically for you to avoid counters with high business risk. In this instance, you must be able to make an analysis which company actually fall into the category of essential good, where it suffer less business risk regardless of the economic situation. But if you invest in IT or technology firms, they seems to be affected a lot during bad economic situation. and their exposure to business risk is basically very high. Alright, now we are going to look at financial or financing risk. Financial risk is a form of risk associated with the usage of external fund in running the business of a corporation. Okay, in this instance, this external fund means that this company might have a long-term loan or short-term loan with the bank or any other institution. So they rely on this loan for them to operate their business. Therefore, once they have this long-term loan or short-term loan, they need to pay the fixed interest expense at a regular time, because once they involve in a loan, it seems that there is an interest, the fixed interest or payment that they have to pay at a regular time. For example, it is monthly, bi-monthly or bi-yearly, okay? And if the fund is high, okay, let's say the long-term loan they make is up to millions, 100 millions, then the fixed interest charge also will be very high. Therefore, for companies who are not depends, who didn't rely on the external finance, this risk seems to be low. But for certain company that actually base or rely on the long-term loan or short-term loan for them to survive, they suffer higher degree of financial or financing risk. Okay, therefore, as a financial analyst, all right, you have to know, you have to be able to analyze whether the company is safe to be invested if, for example, they have this type of risk, that is financial risk. And if the company, for example, if they have high business risk and high financial risk, then this company might be very dangerous for you to suggest your client to invest in this particular company. Alright, now we look at the interest rate risk. Interest rate risk, actually one of the biggest risks that affect the business as well as the investment. This interest rate actually being announced by the central bank of that particular country, and this is something that has been weighted by a lot of capital markets players such as financial analysts, bankers, institutions, etc. Okay, the interest rate, if it is reduced, okay, if it is has been given, if it is decreased, it will actually affect the fixed interest expense that the company have to pay. Let's say the company is having a short-term or long-term loan. Therefore, because of this loan, the company have to pay the interest expense. If, for example, the interest rate is has been reduced, the fixed interest expense that they have to pay will be lower. And if the interest expense is lower, means that their profit will be higher, because the amount of money that they have to pay for the interest expense will be lesser than the previous year where the interest rate might be high. Therefore, once the interest rate has been reduced, it will give a positive effects to the company, for the company to make another profit by paying lower interest or fixed interest expense. Other than that, when the interest rate is low, the fixed income securities also will be higher. This is something that you, the principle that you learn in the investment module. And in this situation, where the interest rate is low, as a financial planner, you need to give a suggestion for your client to invest in fixed deposit, for example, because fixed deposit, they offer fixed interest where it is not that actually very much affected by the interest rate risk, where the fluctuation is much lower compared to other form of investment. Other than that, you can also give a suggestion for the client to invest in a bond with fixed coupon rates, where it is not going to be affected with the announcement of the interest rate risk by the central bank, since the amount of the interest that you are going to receive from the bond with fixed coupon rates is about similar or same. Okay, it gives fixed return. If you expect that the interest rate will be dropped or will be reduced, the financial planner, for example, should suggest for the client to invest in more fixed return, such as fixed deposit, which offer fixed interest for a certain number of years, or to invest in the bond with fixed coupon rate, where there's no fluctuation in terms of return regardless of the announcement of the interest by the central bank. The next risk is inflation risk. We already know that inflation actually reduces our purchasing power. And in general, investors, they expect that the rate of return from investment must be higher than the inflation rate for them to cover the inflation rate. We already know that if inflation rate is high, then the central bank will make an adjustment by increasing the interest rate for them to encourage saving from the market. And in the situation where inflation rate is low, the central bank will announce a lower interest rate for them to encourage spending by the market. So they are not actually encourage saving in the situation where inflation rate is low, but rather encourage the market to spend more for them to generate or boost up the economy. Next type of risk that we want to discuss is foreign exchange risk. In this risk, it actually affects a lot for import and export activities by the company. In the case where the ringgit Malaysia decrease or drop, this situation will give good news to the exporter, which means they will have to pay less due to reduction of the currency of ringgit. Nevertheless, it will give a bad impact to the importers, because the importers have to pay more than usual due to the foreign exchange currency or risk that has been faced as a result of the reduction of ringgit. Other than that, other than import-export activities, this foreign exchange risk also give an influence toward loans and advance from foreign countries. Let's say if the company in Malaysia, they make a loan, okay, or debt with the countries in overseas. In the case of ringgit Malaysia drop, then the loan amount will be increased automatically due to the reduction of the ringgit, and the interest rate from the loan that need to be paid will also increase.